Hello traders, the title of this video is how do the pro trade Fibonacci. Alright, let's get started. We are looking at Home Depot stock. We are on a monthly chart, and I've drawn now the Fibonacci retracement tool here. And looking at this stock carefully here, you can see that from 1991 up to the year 2000, Home Depot went up from $2, let's say $3, up to $70. So during the period of 1991 up to the year 2000, within 9 years, the Home Depot went up from $3 to $70. A huge move. All right. So this is a bullish cycle in this session, all right? But then we see that people start taking profit, investors start taking profit out of Home Depot, all right? After, a bullish cycle has ended. Talking about Elliott wave, we will expect a correction. Here we have a kind of ABC correction that brings the price into the 78% zone. Now the question we are asking is that how do the pro use the Fibonacci? The professional use Fibonacci to invest in stocks. All right, this is very, very important. Contrary to the average traders, professionals do not just buy at 50% or 38% or 61.8 or 78% like ordinary traders are using the Fibonacci technical tool. Professional, if they are about to use the Fibonacci tool, they will also check the fundamental, because they want to hold position or they want to buy and hold, they want to invest in a company. They will check the fundamentals, very important, and then they will wait for the price to be discounted. So the first stage is to check first whether the company is a good company. When we want to know whether a company is a good company, we want to check the return on capital. The return on capital, the higher the return on capital, so you choose, for instance, I nearly speak French to you guys, my apologies to traders. So if you are looking at stock for the stock listed on Dow 30, all right, you want to compare these stocks and know which one is the best stock, which one is the good company, all right, the best company. You want to compare the return on capitals. So you select a different stock and you compare their return on capital. Go to www.Google Finance, go to www.Yahoo Finance to start learning the fundamentals. So the first stage, that professional checking, is he a good company? So attention on the return on capital. The next thing, they want to know, now if it's a good company, they want to buy, but they don't want to buy at any price. They want to buy, at a discounted price. And the professional will use Fibonacci retracement, to highlight the discounted stocks. Now, before I continue, I need to highlight to trader that the critical or the psychological price level is the 50% retracement level. So professional will prefer, if the company is really, really good, they will prefer at least 50% discount. I don't want to dwell on the 50% retracement level because I will come back to that in another video. But professional always, very often, what we have noticed is that they would like to buy around the 78% Fibonacci retracement level. Now, around this 78, some traders say 78.6. I keep mine simple at 78% exactly. So if you are using the Fibonacci like a size, do not worry, I use 78%, all right? So you will see very often, if the company is a good company, which means we check the return on capital, we check the balance sheet, we check the cash flow, the net profit, all right? After everything being deducted, salary and everything, now we know, we check the management, we check the competition, how the company is coping with the competition, and we check their future vision, what will happen to them in 2 or 3 years' time. Now, so we know that it's a good company. We do our verification, checking the management, checking the product, checking the competition, projecting everything into the future. Now we are satisfied. Professional, will expect the price to go to 78%. If a good company with excellent management, excellent products, coping excellently with the competition, reaches the level of 78%, professional will keep buying it. They will keep buying it non-stop. They will, in fact, the word they use is to load it. They will load 78%. You see here, Home Depot, as I told you, from 91 to 2000, it went from $3 to $70. Gorgeous, isn't it? Long term. What I say to traders is that trader must not have only one trading account. They should have at least 2 trading accounts. Also, one should have an investment portfolio with a dividend reinvestment plan, DRP. Very, very important. So you want to check with your bank whether they have a share portfolio that you can open with a dividend reinvestment plan, and you can buy and hold for long term. All right, very, very important. So now the stock went up to 70%. Now professionals know that it's time to start taking some profit. Gradually, everybody started taking profit. The stock went back to 78% retracement from $3 to 70. The price is now discounted at this point in time in the region of $20. Region of $20. That's a 78% discount. The price was $70 before. Now it's $20. Almost 78% discount. They start loading it, provided that the company is excellent. The difference between the professional traders and the ordinary traders will just buy. As you can see, some traders will ordinary traders will try to buy 38%, 50%, but professional will prefer at least 50% or below it. The best place, the key level I want traders to remember in this video about how do the pro use Fibonacci. They keep buying good companies, excellent company with excellent management, excellent products that are coping with the competition very well with excellent future. They keep buying them at 78% Fibonacci retracement level. So how do we put this into use if we want to open with our banks, a share portfolio, all right? We may go and scan for stock. I do it manually. You can go and just check them manually. Which stock has given us 78% discount. Good. Now we want to check return on capital, check the management, check the product, check the competition, project their strategy into the future to see what will happen to them into the future. Now another tool that professional using is the earning yield. Go to Google, check what is earning yield. All right, earning yield. That's allow us to detect which stock also is at below its fair value. All right, we want to know whether it's discounted, all right, and we want to know whether it's a good company. And using the Fibonacci, professional will keep buying at 78%. Here they buy it in 2003. They bought it. Stock went up from $20. It went up to $43. Double. Then again, we know that in 2007 we have the credit crunch, which brought the price back down where exactly the same level, 78%. All right, now you see it. So using the Fibonacci allows us to know how much a stock is discounted. All right, so do not use the Fibonacci, especially if you are a swing trader or you use option, put option, call option to make decisions. All right, you want to watch a level of 78%. Now I want to remind traders that I want to bring on another stock, which is the United Health Group. I told traders not to try to sell this one because of what we have said about the Dow root indicator. All right, watch it carefully. Now, same thing happened here. We can see that United Health Group, which is another American stock listed on the Dow 30. We can see that the stock start going up from let's say 1999, from the level of $6. From the price was $6 in 1999, and slowly but gradually start going up from 1999 up to 2006. All right, 2006. January 2006, end of January 2006, it reaches the level of $62. So from $6, the price went up to $62 That's 10 times, okay, multiple. You see here? So if you buy it here and hold it all this year, if you can hold it and be patient, from 1999 up to, okay, this is a big, huge cycle, all right, up to 2006, okay, from $6 to $61, that's, okay, 10 times, okay, multiple. From that point, okay, very often when the stock went up 10 times, okay, its original price, the market very often will think that it's overbought. Remember that, okay? If the stock went up 10 times its original value, very often the market will consider it as overbought. Doesn't mean that the company is performing poorly, but people are just taking profit gradually. This is what has happened here. So from 2006, we see that there was an original profit taking, followed by the 2008 okay, credit crunch, and when the price went down again to the 78%. Can you see on your chart where I'm moving my cursor? Again, the same Fibonacci level, 78% Fibonacci retracement level. The price is discounted. When we see a stock reaching 78% Fibonacci discounted zone, we will now go to Google Finance, we will go to Yahoo Finance. Very, very important, traders. It's not all about technical alone. Though Fibonacci is a technical trading tool, one can combine, that's the way professionals are combining the technical with the fundamentals. Sometimes you hear professional traders saying that I'm a technical trader, so which means he knows that the price reaches 78%. He may not directly check the stock itself, but he may check the sector. No, generally that, okay, now it's time to buy gold, it's time to buy commodity, it's time to buy stock, or it's time to sell stock, and he or she will use the Fibonacci, okay, retracement, okay, 78% to make his or her decision. If it is time to sell commodity and you see a stock that is rally up to 78% Fibonacci retracement zone, he or she may look for opportunity to sell. On the other hand, if it is time to buy commodity and he or she sees a commodity that pull back to the zone of 78% Fibonacci retracement level, he or she may decide to buy and hold. These professional and technical traders, but they are paying attention to the general market, okay, a cycle and fundamentals. All right, this is about how do the pro, okay, use Fibonacci. All right, now traders must understand that the most important thing is that when we are about to buy and hold, we must buy quality, but we don't want to pay the highest price. We want to pay the lowest price. Professional will use Fibonacci retracement level, especially the 78% okay, Fibonacci retracement level, to dictate or to identify, okay, discounted, okay, stocks or financial instruments. All right. One thing traders must understand that it is very important to check Google Finance and Yahoo Finance because we want to know the fair value. Okay, if something called the fair value of a watch, for instance, is $50, all right, or £50, okay, but for one reason, okay, the quality did not change, but if the price went down to okay $10 or £10. We will be happy to buy because we know that the fair value is $50. But now, for one reason or another, there was a panic or a fear, people sell it, and the price went down to $10. But the quality remained intact. We will be busy buying it and to resell it. On the other hand, ladies and gentlemen, if for instance the price of my Galaxy Note is now okay, the fair value is $20. For one reason or another, the price went up to $1,000. Okay, all right. That's overvalued. All right, we will be very fast to sell it before the price return back to its fair value. The market is always correcting itself. Financial instruments that deviate too far away from their fair value are likely to return back to their current, okay, very important, current, okay, fair value, not previous fair value, okay, because if the fundamentals are improving as the price moving away from the previous fair value, there is a new fair value being established as the price is moving up, okay. I hope you have enjoyed this video and will put into use, okay, to make excellent decision. This is about how do the pro, okay, trade a Fibonacci or use a Fibonacci. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS008 traders. Speak to you soon.